Hello, all channel members. Thank you so much. Happy Monday. Happy trading. I hope we're going to make a lot of money. Thank you for this coffee. This is on you. So since you guys are supporting my channel, I wanted to support you with some content specifically only for my channel members, specifically to some plays that we've all been doing. Now, I shared some of my options plays on PayPal. And fair warning, I got this option play from Jesse Dow. He is also a channel member. A lot of people know who he is on Twitter, and I've been shouting him out before it was cool to shout out Jesse. So shout out to Jesse. Right or wrong, I take responsibility for my own investments, and none of this is financial advice. I'm not qualified to give financial advice, nor would I ever want to give financial advice. With that said, I don't just blindly follow. When I invest into something, I do my own research. And many times on Jesse's plays, even on the crypto plays, I like to evaluate it, and I actually share my information with him one way, shape, or form to try to connect the dots, because I like to connect the dots, right? I'm just not good with technicals, although I am learning how to do technicals. So in this video, I wanted to break down PayPal and the thesis of PayPal and maybe just bring some more knowledge to people that are a little bit less knowledgeable about PayPal. Now, this is my first review of PayPal. I've been reviewing it for, probably the last day or so, gathering a lot of information. I'm going to give you my thoughts and I'm going to break down the information. So PayPal right now is broken down into a few different segments. PayPal has something called PayPal branded, PayPal unbranded, PayPal Venmo, I'm going to put it in, and then you have PayPal Complete. Now, branded is essentially PayPal. Every time you go out and you click on PayPal, that is branded PayPal. Unbranded PayPal is considered to be something called Braintree, and Braintree is also in connection with PayPal Complete. That is also unbranded. So Braintree is an enterprise level, large corporation answer for checkout for e-commerce. And PayPal Complete is more towards the small business and mid-size business. Venmo is essentially anything you can say P2P. And under Venmo, there are some sub-umbrellas, but for the most part, it is Venmo. So now you know the segments. Branded, unbranded, which is Braintree and PayPal Complete, and then you have Venmo, which is peer-to-peer. And all of that put together brings in something called TPV, which stands for Total Processing Volume or Total Payment Volume. And this TPV is now at $354 billion. The TPV continues to keep growing. So PayPal, despite its price performance, is actually a growing company, and it's actually a cash cow. And although they don't do dividends, they do have a buyback program for stocks and investments, which means they prop up the price of PayPal shares. This is actually a very, very good thing. So on the surface level, the price of PayPal is near all-time lows. It's literally up like 80% from its inception. But think about that. This company is a major player with super brand recognition. You know it. You use it in your everyday, buy, sells, so on and so forth. And it is a growing company. Meanwhile, the price is absolutely in the shitter. Right now, it's like trading at $66 or something. And later on in the computer, I'm going to show you the PE. And the PE ratio is as low as it's ever been, period. Think about that. Price is down the drain. Sentiment is an all-time low, which is the PE. However, the company is still growing. It is still a behemoth. And I'm assuming that's why a lot of people are starting to buy PayPal. Remember, we don't care as options traders what's going to happen to PayPal in 10 years from now. We care what's going to happen between now and the next 12 months or so that we can make our massive returns, multi-baggers, and get out of this play. So that's all we care about. We don't care where PayPal is going to be in 2026, 27, 30. We don't give a flying fizzle. We just care how can we make the most possible returns. And I believe one of the factors why Jesse likes this play is the extremely low PE ratio. The low PE ratio means that nobody is giving PayPal a chance. However, as Jesse says, I like to read the tea leaves, and you got to look at the company. Is the company still growing? Is it dying? Yes, it is growing. And in a moment, I'm going to explain to you why the sentiment for PayPal is so low. So the problem right now is the branded PayPal option is much higher margin, while the unbranded is a lot lower margin. But the unbranded is growing at 30%, while the branded is only growing at 6.5%, which is still not bad. It's still growing. Because of that, the profit margins of PayPal is going down. And this is one of the reasons why PayPal dropped like a freaking anvil after the last earnings. So what is the point of this? Why would they want to do branded versus unbranded and vice versa? As per the CEO and the C-level executives, they're saying that there is mega expansion potentials for gathering data and expansion throughout the entire world, globally. And that expansion globally, number one, is going to increase the margins, unlike in the US. And more importantly, it's data. So they're heavy into AI. They keep saying AI, AI, AI. And I don't know if they use Palantir or not, but the origins of Palantir was the program that was used in PayPal back in the day when it was, taken over from the original company. I forgot what the company was that Peter Thiel and Elon Musk found. And this AI that they're working with now, whatever programs they use, whatever software, it could be Palantir, I'm not exactly sure. They put in this data to make them the best payment processing company in the world. That's what they want to do. So they said they are building a huge amount of relationships and gathering a huge amount of data from the unbranded packages that they give people. And the unbranded is the Braintree. And when they purchased Braintree for like $890 million, they actually got Venmo from it, and also this PayPal Complete. So that's the unbranded. Versus branded is PayPal. And then you have Venmo, which is P2P. So that answers the question of why would they grow an unbranded business that gives them less margin when the unbranded business essentially does the same thing as PayPal. So PayPal, Braintree, and PayPal Complete all essentially do the same thing. They're payment processors. There are differences. There is levels of securities. There's levels of integration. For example, Braintree allows heavy integration from developers, while PayPal does not give you this heavy availability of integration. Also, PayPal Complete is specifically for small and mid-sized businesses. I'm not rambling. I'm trying to explain what I think is the reason of this expansion and why they're willing to lose margin now, today, to be able to expand later or tomorrow. It's all about the data to make them a better company. Now, that later, hopefully it comes within the next 12 months. Hopefully in 2024, it's going to freaking, go through the roof. That's what we're counting on with this options play. Now, one of the main things you got to understand besides for the branded and unbranded is the P2P. So P2P is growing. So Venmo is for the younger generation, the millennial generations. And for Venmo, you can now send crypto besides for just buying it. You could do multi-payments with different amounts of people or to different people. And they're about to do Venmo to PayPal and PayPal to Venmo availability. Not to mention they're opening up something called Venmo Teen Accounts, which is a hot product from parents. Parents want this. Also, Venmo has a lot of partnerships. They have a partnership with McDonald's. They have a partnership with Microsoft Xbox. So PayPal has a lot of room to grow. You might say, well, Adam, what exactly is the percentages? So PayPal branded of all of the transactions is 30%. Unbranded is also 30%. P2P, which is essentially Venmo, is 26%, and others is 14% because they do have a couple of other products, but they're small. Venmo is growing like crazy. Unbranded is growing like crazy, and branded is still growing. Might not be like crazy, but it is still most definitely growing. As unbranded is growing heavier than branded, they are getting a lot of relationships and a lot of data and a lot of future growth potential, but they are suffering in their transactional margins, and the cost to cover unbranded is more. So margins are less, costs are more. And that's why analysts are very worried about PayPal, because they're saying, well, if unbranded is growing so much more proportionately to branded and unbranded costs more to service and margins are less, this is a problem to PayPal's bottom line. And to this, I'm going to go over the EPS, earnings per share, and revenue, including revenue guidance, in just a moment by my desk. And I honestly don't think it's going to be a problem. I'm not saying PayPal will become a behemoth like it was. I'm not saying it's going to hit $300 a share. I'm not saying that's what's going to happen. But I do believe that PayPal has a very, very good chance to hit triple digits. And if PayPal hits triple digits, I think that we're going to be well rewarded. Now, if PayPal hits $150 a share, I think we're going to Valhalla, we're going to the promised land, and we are going to make a shit ton of money on these options. I want to just go over some key metrics, and then I'm going to go over to my desk to actually show you some charts. The total payment volume was $354 billion. The net revenue, $7 billion. Just listen to these huge numbers. $7 billion of net revenue. This last quarter alone, that's not for the year. They have $7.1 billion of cash and cash equivalent. They have short-term investments of $3.5 billion. That's giving them interest rates. That's probably like treasury bills. Long-term investments, $4.6 billion. Now, their long-term debt and short-term debt combined is only $10.9 billion. So their cash equivalent, and investments is outpacing their debt, which is always good. This is where the numbers really suck. Transactional costs, so these are the costs to do with transactions, was $3.725 billion. However, last year it was $3.186 billion. And last year it accounted for 49.1% of revenue, while this year it accounted for 52.9% of revenue. So the transactional costs is going up, which means the margins are going down naturally. But the non-transactional costs are $1.715 billion, while last year was $1.954 billion. Last year was 30.1% of revenue, and this year it's 24.4% of revenue. So what happened is, since everything is getting more expensive for the unbranded, and the margins are less for the unbranded, and unbranded is now the equivalent of the branded, what they're starting to do is cut down on all expenses not related to transactions, which means, cost of how much they're paying employees, cost of marketing, cost of promotions, so on and so forth. There's a huge list. And one of the fears, whether it's right or wrong, you guys can make up your own decision, is how much can they possibly keep offsetting the total cost, which they reduce total non-transactional costs by 12%, I'm sorry. How much can they keep cutting costs in order to offset the diminished margins and increase costs to carry the unbranded products? And that's only something you can tell yourself. And again, I want to stress the play for PayPal is not a 2025, 2026, 2027 play. The play for PayPal, even though the options that I have is January 2025, in reality, you want to be out of this play preferably within the next year, which could mean a month, it could mean 12 months. That's when you want to get out. And if anybody's wondering what PayPal plays I did, it's PayPal, January 2025, $145 strike, call, leaps. That's the play over here. I'm going to go over to my desk and I want to show you some other metrics and some other charts. Let me know before I go there, what do you like or don't like about these videos? Because I am literally catering these videos to my channel members, so I want to make sure you guys get the most out of this. In the future, I will keep doing these type of videos if you guys like this. My whole job here today is to give you guys value. You guys are very generously giving me $3 a month, and I appreciate it. I'm not trolling you. That's unbelievable. Thank you so much. And you guys buy me my coffee. This, number one, feels great besides for the monetary gain. And I want to make sure that you get your $3 worth. I think I'm giving you value, but I want to make sure I'm giving you value in these video breakdowns. So let me know in the comments down below if this is something that you like and you want me to do more of, specifically to the options plays that I'm pushing on this channel. But none of this is advice. And by pushing, I mean entertainment and educational. I'm not telling anybody to buy, sell, or trade. Let's go over to my desk. All right, guys. So the very first thing I want you guys to pay attention is the chart over the last 5 years. For the last 5 years of this absolute behemoth, we are down 20%. Could you imagine that? And all time, we're only up 77%. It's absolutely freaking comical. And we're talking about we're going back all the way right here. All the way back to 2015, guys. All the way from 2015. We only doubled, not even doubled from where we are in 2015. So now if you go back to 5 years, we're actually down 10% for 1 year. Year to date, we're still down. 6 months, we're down. And only for the last month, we had a decent month of 13%. But let's actually look at this. So this is what happened in the beginning of coronavirus. And then it shot up from $86 all the way up to $300. Then it came down, and now it's just like down, down, baby. Nothing good. So you got to ask yourself a question before we go any further. Is PayPal a better company now than it was pre-pandemic, right? So I want you to look at this chart right here from January 2019 all the way up to around February 2020. I want you to look at this chart. Even go back right here, okay? Is PayPal as good a company or better than it was right here in 2018? You guys don't believe me? Let's even go back. Let's go back to this point right here. Back in 2017 until 2019, right before this whole uptick of everybody staying home because of coronavirus, is or is not PayPal a better company than it was? Well, let's try to answer that question. Let's go to the financials. If you go a little bit lower, this is going to be the quarterly. Now this is going to be for the annual. This is the financials. In 2015, so this is the earnings per share. This is how much you're making per share. In 2015, the estimated was $1.27. We did $1.29. Estimated 149, we did 150. 2017, estimated 187, 190, 240, 242. This is where it's going to start getting juicy. This is right around when Corona is going to start. After this, 307, 310 we beat. Then we had an estimated 377, we did 388. And this is the magic year right here. We estimated 460, we got 460. So it's absolutely huge. We did make a lot more revenue during coronavirus. However, we did not make 2x more revenue, okay? Look where we went, even right here. You know, you could even go back to 2018. From 2018 to the coronavirus hike, that's when we made just about the 2x. But then 2022 slowed down, and we were estimating 408, we got 413. But now let's do some numbers. So this is our height. This is when we hit those $300 a share. But in 2023, we're still estimating 495. Then we're estimating 567. And then we're estimating 637. Now, I don't care what happens past this. And all I really care about is what's happening right here. So as you can see, the revenue is actually growing. As a matter of fact, the revenue is growing more so than it did before. And by revenue, I mean the earnings per share. So now let's go a little bit lower and actually go to revenue. Okay. Well, we estimated, this is for the full year, okay? Back in 2015, we estimated 9.2, we got 9.25 billion. Estimated 10.84, we got 10.84. 2017, we estimated 12.98 billion, and then we got 13 billion. 2018, we estimated 15 billion, we ended up getting 15 billion. Now I wanted to show you something really, really fast. Remember I said, is our price right here at $67 a fair price of where we were right here in 2017? So let's go back to 2017. In 2017, our estimated revenue was $12.98 billion. And although we don't have our entire year, let's just go by quarterly. Boom. Our quarterly revenue is $7.27 billion of 2017 was 12.98 billion. So let's get this straight. Our current revenue for a quarter is at 7 billion. Our total revenue for 2017 is around 13 billion. Meanwhile, the price of PayPal is the same price as it was in 2017. Guys, you let me know if that makes sense. Let's just try to connect the dots. No, it's oversold in my own personal opinion. This is PE ratios for PayPal. PE is the price to earnings ratio. This is the sentiment of the market, whatever you want to call it, how much you're willing to give a premium to a stock. So in 2017, our PE ratio was 34, then it became 36, 43, and then it was trading these magical numbers in 2017. Until 2019, it was in the 50s. Right now, we are literally at 28. So although our revenue was 7 billion for the quarter of where it was in 2017, 12 or 13 billion for the year, our PE is 28, when in 2017, our PE was 50. Just let that sink in. At the same time, there's a really cool chart right here. This is the earnings per share. You see, the earnings per share is steadily going up, boom. However, there's something that's happening here, and I think this is one of the things that Jesse looks at. Our earnings per share is going up, 174, 197, 209, 236. However, our PE is going down, 38, 40, 43, 34, 32, and 28. Now, this is a problem and also a great opportunity for somebody like myself and maybe you. I'm not telling you to buy, sell, trade, or anything. to come up with a great deal to scoop this up. This is what I was showing you before. This is the margins. So focus on this right here. We had, while volume-based expenses went up. This quarter, 3.725 billion. Last quarter, 3.186 billion. This is the expenses for the actual transactions. And then I want you to pay attention to this line right here. Percentage of revenue is 52.9%, and it was 49.1%. So the transactions are getting more expensive. And this is one of the reasons why everybody is hating on PayPal. And it's a very fair assessment. But again, we don't care about PayPal going to 300. We just care about PayPal going to $100 to $150. That's the magic numbers that we care about right now. 150 a little difficult. 100, I think, extremely, extremely doable. So this is the non-transactional. So in order to offset the transactional, they reduced non-transactional by 12%. So right now, it's 24% of total revenue, and it was 30% of total revenue. Right now, it's 1.715 billion, and it was 1.954 billion. At the end of the day, with your investment into PayPal, you need to ask yourself a question. Is PayPal right now a better company than it was in 2017? For me, that is yes. Is PayPal as strong as it was during Corona? No, but many companies are not. Will it ever be as strong as when it was in Corona? Who knows? Maybe, maybe not. Will it be there by the time my options expire? Absolutely not. Does it have any forward movement? Does it have any forward growth? Absolutely. Their unbranded is growing at a massive rate, and although the margins are lower, it is bringing in new relationships, and it is bringing in a shit ton of new data. Also, they're looking to buy back $5 billion of shares this year alone. They are an absolute monster, and they are expanding globally with Venmo, globally with unbranded, and they're selling off their debt, their accumulated debt for buy now, pay later. They have a buy now, pay later, like in Affirm, for example, which I don't understand why people would buy Affirm, whatever. And the business is doing relatively well, and they're actually selling off that debt that's paid to them. So they're shoring up their books. The CEO is leaving this year. He called this leave a long time ago. He says, once PayPal is going to be in the right direction, I want to leave. I want to concentrate on other things. His name is Dan. Dan is leaving. He's going to name a successor. Nobody knows who that is. It's going to be this year. This can be good or bad for PayPal. I think it's going to be good. A new brain, a new set of heirs, somebody that's going to be, acclimated to the whole PayPal scenario. Again, my play for PayPal is the next month to 12 months. I don't care what's going to happen in the future at this particular point in time. Guys, this is my breakdown for PayPal. This is the reason why PayPal took a dump. Why analysts downgraded them. Some analysts didn't downgrade them so much, and some analysts actually understand what's going to be happening in the future. Only you could tell yourself what's happening with PayPal or not. My job is to give you the data and information. For me, PayPal is a better company today than it was in 2017, and I think that the sentiment is so low. It does not take a lot to change sentiment from negative to positive when the price is so low. Just look at what happened to SoFi. Look at what happened to Palantir. The sentiment was so shitty that just some pieces of good news absolutely skyrocketed the shares. Same thing is going to happen to PayPal if they hit that one piece of good news. Let's see what ends up happening. Let me know in the comments down below if you appreciate this type of content. Thank you so much. I love you all. Have a great day.